Welcome to my channel. I'm the cover call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields about $70,000 a year, just about $6,000 a month. I'm gonna be strictly using cover call ETFs to reach my goal. And leave a comment and let me know what I should do after I reach my goal. I'm open-minded to everything. It doesn't even have to be stocks. You know, if you think I should go and learn about real estate, which I already have real estate of my own, both stocks and actual real estate. Maybe I should do real estate again, and maybe I should do a course on that. But anyways, let me know. I'm open to everything. Before we get started, legal disclaimer: this content is for informational and educational purposes only, and is not financial advice. I am not a licensed financial advisor or a tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, with that out the way, let's do a deep dive on one of people's favorite ETFs to talk about. I know YieldMax get a bad rep, but it is for some investors who can stomach, you know, the YieldMax products and their strategies, right? It might not be for a lot, but it is for some. Personally, for me, it's not for me. But anyways, I still want to do my due diligence on it. I want to talk about it, and perhaps people watching this might rethink their strategy, might get back into it, or if you're new, you might think it's for you. If you hold it, then you might think, all right, this is for me. I was having doubts. All right, but anyways, YieldMax ETFs is what we're gonna be doing a deep dive today, right? This is my due diligence. Please conduct your own. I could be wrong. Always fact check me. You can leave a comment below. Again, I don't own any YieldMax ETFs, so if you own any, comment, let me know. You have first-hand experience, and I could be wrong, right? This is going to be an in-depth due diligence and risk analysis for income investors. Let's begin. All right, part one, the strategy and mechanics. The core strategy. What is the exact option strategy? YieldMax ETFs use a synthetic cover call strategy. I made a video on that. Please check it out. This is a fundamentally different from a traditional covered call. Instead of buying 100 shares of a stock and selling a call option, they create a synthetic long stock position by simultaneously buying a call option and selling a put option, a combination known as synthetic long. They then sell a separate call option against this synthetic position to generate income. All right. So an analogy here is like it is like renting the stock's price exposure for a fraction of the cost and then subletting the upside by selling the call. And then question two, physical shares or synthetic, right? They use synthetic exposures via option contract. They do not own the underlying shares, which is very important to understand, right? They don't own it, right? TSLY does not own any Tesla stock, right? This is a fact. This is a key reason for the fund's risk portfolio, right? There's no actual shares in the fund to provide a hard asset value, and that is one of the biggest reasons why I don't own any YieldMax. I like to have the ETF own the underlying or indirectly owned the holdings if possible. For example, BTCI, right? Bitcoin, it doesn't physically own the Bitcoins, right? It doesn't have it's not your keys, not your coins, right? But they own the ETF that actually owns the Bitcoin, right? So it indirectly holds control. And that's what I mean. That's just an example. Options and collateral, right? Question three, what type of options are sold? They primarily sell short-term, weekly, or monthly call options that are typically at the money or slightly out of the money. All right, that's another big reason why I don't like touching YieldMax. This approach aims to maximize the premium your income collected as shorter term At the money options have the highest ex, ex, extrinsic value. This strategy maximizes theta, which is time decay, which is the primary source of the option premium, right? So you have to maximize that time decay. The further out, the less the premium is going to be. How does the collateral structure work? The fund hold their assets primarily in US T-bills. I don't think a lot of people actually know this, right? Fun fact. These treasuries serve two purposes, right? To act as a collateral to back the synthetic co-option positions, which require margin. They generate a secondary income stream for the fund from the interest paid by the treasuries. And it's going to get worse when the treasury rates go lower. So it's going to be much, much harder. Something to look out for if you guys own YieldMax products. All right, this is just a generalization. All right, it doesn't really have to do anything with YieldMax in general. It's just a generalization of cover call ETFs, how income is generated. There's just different type of income streams, right? Earned income, profit, interest, dividend, rental, capital gains, royalty income, right? It's just explaining the type of income, how cover call ETFs can make their income to distribute to you, the shareholders. Part 2, yield, cost, and performance. I should probably took that away. Anyways, that this looked right when I was typing it and reading it in my head. All right, yield, cost, and performance. The unsustainable yield. I bet you guys see this a lot. You guys probably see this a lot on X, formerly known as Twitter, or on Reddit posts, or other YouTubers talking about it, right? Oh my God, YieldMax is unsustainable, and blah 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 blah, right? So, a lot of the YieldMax products almost pay like 50% plus, right? So, is this yield sustainable? The main question, right? Is it sustainable, right? The distribution yield are extremely high, often 50 to 100% plus annualized. However, this yield is not sustainable or guaranteed. It is a direct result of two factors, right? High premiums, selling options on highly volatile stocks like Tesla, NVDY, coin to generate large premiums. And then two is the NAV decay, right? A significant portion of the distribution, I don't know if I'm even saying that right anymore, right? It's often paid from the fund's net asset value, the NAV. This capped the upside and has the full downside, right, of dynamic, often leads to NAV erosion over time, meaning the fund is in part returning your own principal to you disguised as yield, okay? You guys have to understand that, right? We love return of capital, but please understand, I did a video on rock, okay? Please watch it. So then you have a better understanding of good and destructive. Of course, I'm about to get to it. This is often classified as destructive return of capital, rock, which is not a profit but a refund of your own money. So when you see this high juicy yield, is literally when they have 50% plus, it's just giving that 50% plus to you, right? If you get a $5 payout, but the stock price dropped for $5, what exactly did you gain, right? You gotta see it that way. You just I invested $5 just for you to give me $5 by the stock price dropping by $5. So what did I gain? Okay, so that's why a lot of people on social media such as Reddit, X, or YouTube talk about the unsustainable yield. Right, it's eventually some of these products are going to zero. Right, it's not a matter of if, but a matter of when. Right, expense and payouts. What is the expense ratio? The expense ratios are high. For example, the individual single stock like TSLY and NVDY typically have a gross ratio of 0.99, and that to me is truly disgusting for the type of returns you're getting, right? If you were getting extremely good NAV gains, capital appreciation plus a juicy payout, then 0.99 expense ratio is 100% worth it. You know what? Take more if you need to if it was that great, right? But it's not, right? You have to look. And then the fund of fund, YMAX adds an additional layer fee, bringing its totals to 1.28, which is absolutely disgusting to me because in long term, you are basically paying the fund manager to give you back your money, right? The 1.28 fee, 1.28% fee is a fee on fee structure, as YMAX pay its own fee plus the 0.99 fee of the underlying ETFs it holds, known as acquired fund fees, right? So you really have to look at expense ratios. That's one of the things I love about the Goldman Sachs and NEO's products, right? Goldman Sachs is 0.29, NEO's is 0.68. Yes, that is high, but when you look at the ETFs and the products they offer, they are in a class of their own, right? They manage it well. They have a great strategy. The fund manager executes those strategy perfectly, and sometimes if they mess up, it does hurt a little bit, and then they show that they can recover. We like to see that, but with YieldMax ETFs, they're just pumping out and churning out ETFs, saying here buy, 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 without actually proving results, right? So how the next question is how frequently are distribution paid? They are paid monthly or and are distributed in cash. Now some of them I believe are weekly. I think the example I used were monthly. That's why I had monthly. All right, some funds in the YieldMax suit, like the 0-day expiration funds, may have different schedules, but monthly is the standard for the core funds. Volatility and NAV correlation, right? How volatile is the NAV, right? And it is extremely volatile because the funds synthetically track high volatile single stocks. Their NAV and market price fluctuate dramatically, often in line with the underlying asset, right? It's very concentrated because it just is following one stock. How does NAV correlate to the stock? The NAV has had a high positive correlation with the underlying asset price, but with a critical divergence. The key asymmetry on up moves, the NAV participation is capped. If Tesla rise 15% in a month, TSLY's NAV will not rise 15%, right? On a down moves, the NAV participate in nearly all of the downside, minus the small premium collected. This asymmetry is the primary driver of NAV decay. Okay, this is one of the biggest reasons why you always see on the subreddit on YieldMax, why is my stock price going down? What's happening? It's because YieldMax, for the most part, not all of them, I would say a majority of them, they don't have a great strategy behind the hood, right? It's just yield, yield, yield. So when you buy the yield and you don't look at anything else, you kind of get this result. The core trade-off, capped upside, full downside. This is again all of cover call ETFs. I wasn't able to put the graph in correctly, but just to let you know, all cover call ETFs experience this. YieldMax might experience it more than others. Again, it's just that this is just the core trade-off of all cover call ETFs. Part 3, risk and taxes, right? Assets and downside risk. What are the underlying assets, right? The funds replicate high volatility single company stocks, primarily in the tech and crypto sector. Example is Tesla, NVDY, Coin, Amazon, Google, and MSTR are some of the well-known indexes. This is not a diversified basket. It's just a collection of non-diversified funds. So please understand that, right? You're buying literally damn near leveraged, but they're not leveraged stocks, the YieldMax products. How is downside risk managed? It does not effectively manage downside risk, right? The only risk management is that the premium received from selling the call option, which provide a very small buffer, the fund is fully exposed to the downside of the underlying asset, and this risk is magnified by the single stock concentration. The destructive return of capital, right? Tax implications. The distribution are generally not qualified dividends. They are a mix of ordinary income from options, premiums, and the treasury interest taxed at your highest marginal rate. The ROC, this is the key. ROC is not taxed in the year it's received. Instead, it reduces your cost basis. Good ROC often occurs when a fund passes through a non-taxable cash flow while the NAV is stable. Bad ROC, right, or destructive ROC. This is what likely occurs with YieldMax. It is simply the fund returning your own money, returning your own investment principal to you because the NAV has decayed. You're getting your own money back, which is then taxed as a capital gains when you eventually sell. It creates the illusion of high income, but is often just capital depleting mechanism. Income source versus total return. Income source breakdown, well, the vast majority comes from option premiums. A smaller, more stable portion comes from interest on the UST bills. Effect on total return, it severely damages the total return potential, especially in a bull market, by selling at the money slash on the money calls. I don't think they sell out the money calls. I'm pretty sure it's on the money. The fund capture upsides. If the underlying stock has a strong rally, YieldMax investors miss it entirely, right? So total return equal price appreciation plus distribution. With YieldMax, the price appreciation component is often negative NAV decay, meaning it distributes more to offset the capital loss. I don't think they sell out the money. I'm pretty sure I put this as on the money, at the money, on the money. I don't think they sell out the money, but yeah, I'm pretty sure it's at the money. Right, ignore this. Part 4: fund structure and operations. Liquidity and management. Is assets under management, right? How liquid it is, right? Liquidity varies. The more popular funds like TSLY have higher average daily volume and reasonable spread. Newer, more niche funds have lower volume and wider spread, right? TSLY's high volume suggests it's heavily used by short-term traders, not long-term investors, right? What about the assets under management? Vary significantly. Some of the core funds have gathered substantial assets, hundreds of millions, while newer ones are smaller. So sufficient exists for the main funds to operate. Fund manager, right? The fund is managed by Title Financial Group and sub-advised by Zega Financial. Zega is a options-focused asset manager, so the managers are experts in executing options and synthetic strategies. Returns, performance, and lockups. Historical returns. Historical return has significantly lagged simply by buying and holding the underlying assets. Well, that's of course the most powerful cover called ETFs. While yields are high, the NAV decay has been so severe in many cases that total return, right, NAV plus yield is flat or negative. Market performance. In a bull market, they extreme underperformance, and a sideways is probably the lifesaver for YieldMax, right? It's ideal, collects high premiums while NAV is stable. Bear market, extreme underperformance, capture on the downside, and it would probably blow up some of the funds. Key takeaway: the fund only wins in a very specific, rare, unpredictable market conditions, right? High volatility, but a flat price, which is, I don't see that happening in the future. I don't know, but it could happen, but I don't think it's going to happen. Lockup potentials. Nope, they are an ETF, so it can be bought and sold daily on the stock exchange like any other stock. Part 5, deeper risk. Prospectus risk, leverage, and premiums, right? So what is the prospectus risk? Single stock risk, non-diversified, option risk, complex and high volatility, synthetic instrument risk, counterparty risk, and risk that the strategy may not succeed. Leverage, the synthetic long position itself can be seen as a form of embedded leverage, but is not true leverage. It uses derivatives to replicate a $100 stock position without actually spending the $100. Right, so this is not a 2x or 3x leverage, but it is 100% derivative base, which carries its own risk. Premiums collected, this variable based on the VIX, right? The VIX is how volatile the market is of the underlying For a stock like Tesla, the implied volatility can be very high, allowing the fund to collect significant premiums. Turnover and changes, right? Portfolio turnover. The turnover rate is extremely high. The fund is rolling, which is closing and opening new positions weekly or monthly. What does that mean? Tax implication. This high turnover generates significant trading costs and, most importantly, result in short-term capital gains, which are taxed as ordinary income, making the funds highly tax inefficient. Regulatory changes. You must always check the fund's website for this. There are complex products, and investors should always read the latest shareholders' communications. For YieldMax products, they are quite active on X. They don't always get the best replies in their posts, but yeah, they're pretty active on X. That's probably one of the best things about them, is that they're very active on X and social media. So they beat Neos is I wish they were more active. Amplified, I wish they were more active. Goldman Sachs, I wish they were more active. Roundhill is decent. Roundhill is okayish. They're not too bad. But YieldMax, from what I've seen, they are quite active on the social media. So good on them for that. Part 6, analysis of 10 additional ETFs. All right, these are just random ETFs that I picked. I just went through the list and said, okay, this one, this one, this one. I didn't have any specific bias or just, I just randomly picked this. All right. These the pros and the cons are fundamentally the same for every fund, as they all use identical synthetic strategy. Okay, that's just a note. Just keep that in mind. All right, so Apple, right? It generates high income from a safer, low volatility tech giant. That's the pro. Cons: because Apple has lower volatility than Tesla coin, the income generated will be significantly lower. You are capping the upside of a high quality buy and hold stock. You might as well just buy Apple. It's the underlying itself. Alphabet, Google, pros: offer high yield exposure to a dominant tech AI company that pays no dividend. They do pay a dividend, but I think they pay so little that it's like, what's the point? I think let me double check. Hold up. Yeah, so Alphabet actually pays 21 cents quarterly, which is which is a dividend yield of 0.30. So it's not even a goddamn 1%. So yeah, it basically doesn't pay anything for the price. I don't know. I don't think that's worth it at all. I don't know. Okay, you guys decide. All right, the cons: you miss out on all of the actual growth from Google, and the search dominance in the AI turns a growth stock into a capital depleting income play, right? So, yeah, I don't know. Just own the Google stock itself. I mean, you have a better chance of 15x in the next like 3, 4, 5 years, rather than owning this. And then Microsoft generate income from another blue chip stock. You kept the upside on one of the world's best performing growth stock. Really is one of the best performing growth stock. If I had to hold like one growth stock, it would probably be Microsoft or Google. So, and then of course Netflix. Netflix is notoriously volatile around earnings, which create a good premium. Because it's so volatile, the NAV can implode very quickly. If Netflix had a bad quarter, the premiums will not save you. And then Facebook, another high volatile large cap stock, which is the sweet spot for this strategy to generate large premiums. I think they also pay a dividend, but it's not much, right? So, but cons: you are exposed to a single stock risk of Meta, which is regulatory, ad market, right? They're not well liked, so well, we'll see. And the capped upside of a stock with massive rally potential. And then we come to MicroStrategy, which is I know a lot of people who bought this and are not happy at all. So, pros: an extremely high yield generator. MSTR is a leverage beta play on Bitcoin, and its volatility is astronomical. Cons: arguably the highest risk ETF in the entire suit, right? So this is probably the most single, either you're gonna have the highest risk but the highest payout in this YieldMax ETF product. A flash crash in Bitcoin could wipe out the NAV, and a rocket in Bitcoin would be completely missed. And I think MSTR's YieldMax product is Misty, MSTY. I gotta double check on that. I should probably put that here. I'm sorry. Yeah, I think Misty is like down like goddamn 60% all time. So yeah, if the bear market continues, if we keep going lower, it's probably gonna the fund might not even exist by the end of the year if it keeps going down like this. And then JPMO, JP Morgan, right? It applies this strategy to the safer financial sector of the high yield. The cons, JPM's volatility is low, so the yield will be lower. It replaces a good qualified dividend with a high tax, inefficient capital depleting distribution, right? Tax negative, replace qualified dividends with ordinary income. You might as well just own the goddamn stock, right? So there's absolutely no point of owning a lot of these uh a lot of these ETFs from YieldMax, in my opinion. And then we have ExxonMobil, we have Disney. I'm not gonna go over all of them just because it's you just pause the video and just read it. It's a lot. Right, and then the last one, AMD, right? You might as well just own um the underlying, right? These are great companies, right? I don't think they're gonna go anywhere. You have a better chance of it exploding in price than collecting such small premiums and eroding your NAV for such amazing underlines. And then final verdict: should you buy? Right? The three major risks every investor must understand: one, NAV decay; two, extreme volatility; and third, missed bull runs. So understand that when you're buying NAV ETFs, not NAV ETF, YMAX ETFs, right? You have to worry about the NAV decay. You have to worry that how extreme volatility it has, and then on the missed bull runs for such of these underlines that you could have just owned. Is it worth it? Is it worth it? The cover, okay, when I typed this out and read it in my mind, it was better, right? And I put in quotes, no, you should probably not buy YieldMax product if you are a traditional cover call ETF investor seeking stable income and capital preservation. Okay, some examples are traditional cover call ETFs such as JEPI and QYLD. Okay, QYLD, I'll just put that there because it's one of the most popular. These are not cover call recommendations. I just put there because these are one of the biggest ones. These funds buy the underlying stock, a diversified basket, and sells out of the money call options. Their primary goal is to reduce volatility and generate a reasonable yield. They are conservative income plays. Okay. And QYD, pretty sure it sells out of the money. I should have. Okay, out of the money. Okay, cool. Out of the money. Is it out of the money? Hold up. Okay, yeah, I was right. QYLD sells at the money, right? So I should have put that there. It's not out of the, it's at the money. And I believe JEPI is out of the money. Anyways, not stock recommendations. They're just there. Please do your own research. Okay, these are just examples. And then we have the YieldMax ETFs for Tesla and NVDY. These are not your traditional cover call ETFs. They're high risk synthetic single stock income generation tools. The recommendation: who is this for, right? You should not buy YieldMax ETF if you want to preserve your capital. NAV decay is a core feature. Okay, I just put that there as it just sound funny. You want a safe or stable income. Obviously, if you want to look at your YieldMax products, a lot of them don't seem safe or stable. And you are looking for long-term buy and hold investment. These are definitely not buy and hold for long term. These are more buy, track it, get your profits, move on to something else, right? Rotate it out. You might consider YieldMax only if you're an active trader, not an investor. Please know the difference. You are extremely high tolerance of risk and volatility. You are willing to risk 100% of your principal. Then it might be for you, right? You might not care about, who cares about NAV decay, whatever. Let it go to zero. I'm cool with that. YieldMax might be for you. Please subscribe, comment, and like. Leave a comment if you think I'm wrong, if I need to be fact checked, or if I got most of it right, all of it right. If you think now you might not want to buy YieldMax because of this video, let me know why. If you want to buy it, let me know why. I personally don't own it. I just want to do a deep dive into it because I know a lot of people who do own it. I've heard multiple stories. So Leave a comment if you own it, and if you disagree or agree. Appreciate you guys watching it, guys. Thank you.